The effects of a larger downtrend hinders progress from a double bottom and gap up combination. The narrower 76.49 to 77.99 range provided prolonged support prior to the gap fill despite constant selling volume because of the supporting influence offered by the double bottom's upper boundary. A lower downtrend line is plotted for additional detail after the gap up was filled in September. Significant penetration of the early June downswing point above the lower downtrend line is acceptable given the higher volume at the time. Interestingly, the wider gap up range had a slight incline, but even if that wasn't identified earlier in August, it was less likely to result in a bullish break into the 80s. Selling pressure was still constant despite significantly dropping off after the gap up. A triple bottom range fails, along with the 71 gap fill area. This leads to a long-term bearish acceleration that still does find some temporary support as there is flatter trading in October. On the approach down to the solid long-term 68 level, the 68 level is breached due to characteristic bearish spikes. From a long-term view, price action is neatly contained under the bearish influence of the downtrend lines and the 68 level in the following years. After the old downtrend lines are crossed, they naturally begin to have lower influence. However, they still do affect a steep uptrend with some temporary resistance. Overall, it is a regular bullish reversal with similar qualities to an ascending triangle due to the flatter price action around the upper downtrend line into April. As usual, there is neutral to bearish trading after the uptrend lines are breached, although it is quite a volatile period of trading prior to the bullish continuation. Trading from May to July is generally contained neatly within the old ranges. The old ranges in the 80s and 70s also contain volatile price action quite neatly from September to December, as the general outline of an inverse head and shoulders breaks over the mid-80s neckline range to start an aggressive recovery. This is after the bearish reversal from a fairly common spread-out triple top that contains a single downswing approximately aligned with a strict double top. The only difference with this one is the incline at the start of the range, and the wider and also inclined lower boundary. This is a valid expansion of the range, as early September sees a minor bullish retracement repelled by the short-term trend line, while bearish volatility remains exceedingly high. Not surprisingly, this less strict triple top range, along with the general 100 barrier, still presents considerable resistance as the uptrend is slowed by sharp peaks around the area to begin the new year.